Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to go through the EIA data and look at what is happening in the oil and refined products world, really throughout the United States, but also obviously on a global basis. So in segment one, we're going to look at the crude builds. What are some of the new SPR sales that are coming? And we've talked extensively about crude grades, different slates. So when you hear this commentary around record profits, you have to put into context why and how refiners are operating the way they are. Then in segment two, we're going to talk about how refined product demand continues to be well below normal and why we see that continuing. And then in segment three, we're going to go global, look at OPEC production, why it's steady, what is driving that, and then where some of the shifts are happening on the refined product level on a global basis. So one of the things that we've shown this chart before, and we will show it again because it is one of my favorites. This just shows some of the grades that are available in the world today. So you get an idea on the different type of oils that are available. And some of the problems that we're having right now, there is a massive shortage of middle distillate, i.e. diesel. And so if you can't go and get those grades, well, then you're going to have to pay up for what's available. And then there's going to be other grades that you don't need or want, and those will trade at a steeper discount. So there is a very big bifurcation in the market between crude qualities. So one of the other things that we've seen in the US over the last several years is that refining profits have not really been all that great. And there's always been this bigger shift of, well, we have a lot of shale, we have a lot of light sweet, but refiners in the US weren't built for light sweet. They were built for heavy sours and heavier grades, which is why the Keystone pipeline was so pivotal to bring some of those heavy barrels from Canada down into the US. But without that pipeline, we're still now beholden to what can come from the international market. And because that then puts more power into the Middle East hands and into the floating market hands, so that, again, we now have to go out and compete at a greater clip than if we were able to have pulled this down from Canada. So realistically, over the last several years, we've had a lot of refiners closing. And that has not just been in the US, that has happened in Europe, that happened in Australia, and China has been picking up and building out a lot of this new refining capacity. Now, what is the problem with that? Well, you're beholden to China, because if China says, yeah, we don't want to export, well, where are you going to get your product? And if you can't get the right crude grade or the crude slate, well, you can't make the product or at least the best product possible because of this. So then you get these huge shifts in margin because there's going to be an inherent shortfall of one product, an inherent oversupply of another, and you're going to try to balance this out. So refiners want to run. The whole concept, the whole backdrop is they have to maintain a certain throughput. But how do you make the most profit and how do you make the right product? And it's all going to be based on a mixture of all of these different blends of crude that you see before you. So things like Agena, which is this bottom, if you look at the teal, on the second level, 1, 2, 3, 4, 5, 6 to the from the left, you can see that is a 0.17. A 0.17 means it's very low in sulfur, which can be run through a lot of things, but it's also on the heavier side of 27.3 API, which means that it makes a great middle distillate. Anything that has a lot of middle distillate product that comes out is trading well over normal. Agena is just one example that we talked about last week. But again, you want to be, for the things that have the most value in the market right now, or let's call it the bottom two rows, and realistically across both sides, because they need the heavier crude because they need to make the most middle distillate. But can the refiner run the heavier crude? And that's where you start to get this bifurcation in the market. Now, we'll go through more of this in the FSC show, but I just wanted to highlight again that we're hearing this rhetoric, but it's important to understand that it comes down to what crude is available at what price to make what product. It's not just this they're going to try to obviously maximize profits, but there's also an availability problem that we really need to understand more thoroughly. Now, when we shift to total oil and product stocks, you can see that the deficit widened from 132.7 to 143.8. That's when you look at what is driving that, it's the crude stocks that have dropped, and a lot of that was on land while floating actually went up. But we'll talk about that in more specifics as we go through the next few slides. So then when you look at total crude stocks, land and floating, the deficit widened from 54.9 to 70.4. That is something that we expect to remain fairly stable and start to increase a bit. But then total oil product stockpiles narrowed from 77.9 to 73.4. And that was driven not by middle distillate, but again by light distillate, because the gasoline side continues to build on a global level, while we're not seeing that at the middle distillate piece, where we continue to see a lot of that bullish backdrop. Now, when we shift over to the floating market, you can see that the surplus widened from 11.6 to 22.5. And as we've been talking about, it's going to be a matter of things going from in transit into floating storage, and we'll go deeper into that in segment 3. But here you can see that surplus widened from 11.6 to 22.5. West Suez deficit narrowed from 7.6 to 6.9. That's something that is going to be fairly stable right now, because we did get a decent pull from offshore onto onshore. We had a big build in Europe. U.S. had a bigger build, with a lot of that being driven based on imports. And then the floating storage in east of Suez continued to climb from 19.3 to 29.4. And that's going to be a matter of when does it actually show up. And the interesting piece is when you look at Asia and the Middle East, we had some sizable builds, especially in the Middle East. And that's going to be interesting, because those crudes should be moving, but we're actually seeing that build back up. There could very well be a timing delay, so we want to look at the next 2 weeks, because that's going to be important to see how quickly that clears, or if people are essentially rejecting pricing and they'd rather pull from onshore storage versus seeing these prices go up, because we have seen prices move extensively. Again, something that we're going to talk about in the third segment. So when we look at U.S. crude stocks, you can see that we had a build of 1.96 million barrels. That's still 95.8 below the 5-year average. But when you look at what is causing that, it remains PADD 2. We had a big dip in imports into PADD 2. That's something that will reverse. So PADD 2 had a drop of 1.39 million. That's 36.8 below the 5-year. And then Cushing had another drop of 830,000. That's something where, again, there's going to be a marriage between what is flowing down into PADD 3, what is being kept there. And you can see that the Cushing stocks have decided they've been keeping them fairly low, but whenever they get towards a certain point, you start to see that refill, and you can see that they're managing it at that reduced rate. PADD 3 had a build of 1.92 million, just bringing it 19.8 million below the 5-year average. But that's going to be the manage of imports coming in, making sure that you're getting that heavier crude, because they are going to target that middle distillate harder, just because of the shortages that are in the market. And I don't mean just the U.S. market, but also abroad, because they're going to try to, again, capture that margin and try to make as much of that product as possible. And then PADD 5, as we've been talking about, remains very lumpy, with an increase of 1.75 million barrels into storage. Crude oil production went up 100,000 barrels a day to 12 million. We have it still at about 11.97. I have to run the numbers again as the new data comes out for the frac spread count. We could be just over 12 million, but again, we're right in this range based on what we have operating right now. SPR, once you factor that in, there was a drop of 5.76 million barrels. And that's, again, there was a new SPR sale that was announced. I believe right now it was set at 43 million barrels. The issue at this point is that we're selling the heavier, the sours, but based on who's buying it, China's buying up a lot of it. So it's very interesting to see kind of the shifts in the market and some of the issues that we're having in terms of, what we're pulling out of the SPR or the Strategic Petroleum Reserve, and then realistically, how are we going to refill it, or what is that refill going to look like, and at what price? So here, when we start looking at runs, as we were saying, we figured we thought we were going to kind of hang in this level, just given the back and forth. Our view is that we're between about 93.5 to about 95, depending on what period. As we get towards the end of June, we should be much closer to 95.5, 95%. There was a little bit of a hiccup in Pad 3 with Lyondell's facility with a fire there that has been taken care of. So that's going to be a matter of when that comes on. But in terms of the activity that we see, we expect Pad 5 to remain a bit more active. PBF refiner had to take one of their facilities down for some planned maintenance. So again, that will come back online. So that'll bring things back up in Pad 5, while Pad 2 and Pad 3 will continue to run very strong. And when you look at just where utilization rates are, we're very much in a normal utilization rate. The problem when you're looking at utilization rate is you're just looking at how much of available capacity is being utilized. But when you look at total capacity, it's come down just because we've had refiners that have either shut down, converting to green fuels, or renewable diesels, biodiesels. So again, we've lost some of this refinery capacity. So utilizations are very quote unquote normal, but there's just less of it because we've seen those economics not work. So because they haven't worked, we've had some of those economic decisions to shut these down, which is why when you look at what the policies have really pushed for it, the push has been to, again, reduce oil consumption, reduce gasoline consumption, reduce diesel consumption. So by doing that, you've hurt the economics. So the companies have said, okay, well, I'm not going to make this product because it is no longer profitable. And you're telling me we're not going to be using it in the future. So I will reduce my runs. But again, as we know, we still use it, we still need it, and it's not going away tomorrow. So this is where you start to get this friction in terms of, what is the policy saying, what is the driver, but what are we still using to run our cars, our farms, our trucks, our ships? And again, this is where we continue to see this back and forth. Imports spiked 831,000 barrels a day. That's still 462,000 below the 5-year average. And this is what we've been talking about. This is going to continue to grow as we pull in the crudes that we need, which is the heavy sours, medium heavy sweets, because we don't have that level of gravity in the U.S. With shale is much lighter, between that 42 and 48, but the average refiner in the U.S. operates between 32 and 33. So you need to close that gap, which is why we continue to see that remain elevated. Pad 2, again, always going to be a bit lumpy in terms of imports. That dropped 334,000 barrels a day. That will come back. Pad 3 will be a lot of timing. As we said last week, we thought that the June 3rd number of 1.2 million was low. That has come in a bit higher. You're still well off the 5-year average. They're going to try to close that gap, but at what price? Because when you look at Agena, $13 above dated Brent, which is already at $120 plus $13. So again, there's also that cost side of it. And then when you look at Pad 5, which as we've been saying is going to stay very lumpy, and there was a sizable increase of 823,000 barrels a day, that will drop. We expect Pad 3 to stay about that 1.4, 1.5 million on average. And we do expect to see Pad 5 slow down. But then as Pad 5 slows, Pad 2 will kind of pick up the baton and run with it a bit. Here's your Pad 3. As we've been saying, we expect this to continue to grind higher. Again, not getting to that 5-year average, but we do expect it to be imports to be above or set a new 2022 high, and that's something that we think is going to persist. Essentially, well above the bottom of that level, but off the 5-year. And then when you look at Pad 2, you can see that there was that drop, but we do expect to see a quick bounce and remain well above the 5-year. Implied demand, as we've been saying, the gasoline's weakened to about 9.09 million, down 106,000 barrels a day. We expect it to stay, as we've been saying, at about 9 million, maybe 9 to 9.1. But if you look at what should be happening, we should be moving back up to about 9.3 to 9.5 million barrels a day. and we just don't see that happening given the current climate. Retail sales, we'll talk more about this in the Econ show. Retail sales had a fairly sizable miss. We continue to see the impacts of inflation, the impacts of those costs, and that's showing up in the gasoline side, but it continues to also hit on the distillate side and the diesel front, and we expect that to continue to be a large overhang as trucking does slow, and we're going to talk more about that in segment 2, as we have inventories that have increased and we have retail sales slowing. You have some of these companies that are sitting there with a fairly sizable amount of inventory that they're going to have to work through, which is going to slow down some of that demand. So then when we look at jet fuel, in terms of demand, as we've been saying, 1.45, 1.55 is that level that we're sitting at, and we continue to sit right there. And when we look at TSA data, as we've been saying, it's just going to go sideways and be well off of the normal of 2019. And then when you look at propylene, there was a drop of 525,000 barrels a day. But for what we lost in U.S. demand, we had a big increase in exports. So it's always going to be this back and forth in terms of what is consumed in the U.S., what is sent into the international market. And when we look at pricing in general and this massive essentially heat dome, and we'll talk more about this in segment 2, you're going to continue to see a fairly sizable demand for not only propane, but obviously also natural gas. So then when we look at implied demand for gasoline, this is what we've been talking about. You can see that we are well off of what is normal. When you look at different peaks of 2021, 2020, typically when you look at what is normal, we should be much closer to about 9.3 to 9.5 million barrels a day. And typically we stay there. Now, this is the graduation. We do have school ending. It typically starts last week and through this week, and then next week for anyone who's a little bit later, that will be the last week. But again, we're just not seeing the same type of demand. It will go up. I am not saying it won't go up, but it's going to follow that purple line and be closer to the average than again seeing that shift up because of demand, because of cost, because of those underlying issues, which is going to be that overhang. Now, when we look at crude oil inventory, as we've been saying, it's going to go sideways. They're going to try to manage it at these levels just because with refinery utilization rates at where they are, but total capacity down, you don't need the same type of storage based on the amount of refinery throughput that is in the United States. So again, that's where you're going to see that move down and stay and kind of set these new normals at these levels. So then when you look at supply for crude, we're right at 2018 levels. And again, seeing that we expect that to stay fairly fixed at these points. And then when you look at total U.S. commercial oil storage end products, very, fairly stable. And we expect, as we've been saying, to see these levels continue. Gasoline, as we've been saying, is going to see that flat line. When in the next segment, you're going to see that we're right around that 2015 normal. Nothing too crazy at this point in time. And we do have imports increasing. So we have imports again increasing to 10-month highs at this point after being at a several-year high. And as we've been saying, we expect that to continue to come from Europe and flow into the East Coast. Now, when we look at distillate, you can see that distillate is building, but it's building at a very normal pace, but we need greater than normal. We need the rate of change to accelerate, and you can see that we are still well off that normal, which we'll talk about more in segment 2. Jet fuel continues to go up, very normal. There's nothing to say one way or the other, and we expect this to stay right around this area. Now, when we look at the crude curve, you can see that we're well above 100 through the first half of 2023, well above 80 and deep into 2025. So again, there's a lot of reasons why we expect to see some additional projects get sanctioned, especially when you look further down the curve and we continue to hold above 65, which is usually used as kind of the long-term trajectory on how profitable will this project be, and we don't see that adjusting. We'll probably take this COVID slide out just because most places are learning to live with it. There's really nothing to say. There's some minor lockdowns that are happening right now, again in China, and that's a point of contention in the area, as well as concern for some of that demand and some of the normalcy, if you will, of economic growth in China, which is more of how oil demand will look. But we'll talk more about that in segment 3. And obviously in segment 5 of the Econ show. Now, when we look at crude oil inventories in PADD 3, we're at a 2022 high. We expect this to stay fairly fixed at this point. You can see that there's the draws in PADD 3 typically accelerate as we go through into middle of June, and then they start to flatline as we get into the end of August. We just expect it to have a little bit of a move, but stay fairly firm and fairly flat, especially as we see some of those weaknesses that we've talked about on the demand front starting to really become a bit more pervasive. Now, when we look at Cushing, we're still above the lows for 2022, but we're coming back down. We expect this at this point to kind of remain fairly flat, creep up and come down a bit. But again, as we see as what happened in 2006, 2007, and then again in 2018, is really kind of hold this line and remain at these levels. And then floating storage fell back to 0. And again, this is all the timing delay because imports increased, especially in PADD 3. Floating storage goes to 0. Floating storage will go up. Imports will come down. And you'll continue to see this working piece back and forth due to not only infrastructure, but also coastal limitations, as we've talked about, just based on geography and other. So again, those are some of the stable things that we continue to see. In the next segment, we're going to go deeper into U.S. demand and why we continue to see that softness and why we believe it's going to, again, continue through the summer months.